Hello, fellow investors, and welcome back to Forex Investing. Well, the market drama continues, and there is a lot to unpack in today's video. So, Palantir reported one of the most spectacular quarters we've ever seen from a software company, yet the stock has been down since. There was a lot going on, so in this video, we're going to try to break it all down. We'll go over some of the key numbers from Palantir's earnings call, and we'll discuss what's really behind the recent price movement because it's about just as unique as the stock itself. We'll also discuss current market sentiment and why we retracted so much on the large tech names. And finally, I'll also cover the recent news around Nebius. So stick around for that if that is a name you're following. So first off, Palantir earnings. So Palantir is doing something no other software company is doing. They've built a very unique asset, a combination of AI platforms, government data integration, and commercial expansion that simply has no real peer. Their growth is incredible, and what's even more impressive is how they're scaling. CEO Alex Karp really said it best. These are arguably the best results that any software company has ever delivered. So that's a very bold statement, but looking at the numbers, it's hard to disagree. It was obviously a double beat with revenue up 63% year over year. And what was interesting is that commercial revenue was up 121%. So that was always a criticism of Palantir that there wasn't enough commercial clients. But as we see, it's scaling and they're getting more and more of these. And here's a part that was kind of shocking. They signed 40 new deals worth over $10 million each in the last quarter. So no other software company has ever come close to that. Their Rule of 40 score also improved from last quarter. And I think by now everyone knows that they have this insane Rule of 40 score of 114%, which really puts them in a league of their own. But I actually wanted to bring up a separate metric, which I thought was very impressive that wasn't really covered on CNBC or Bloomberg. They had a net dollar retention of 134% in Q3. So net dollar retention measures how much revenue a company keeps and expands from its existing customers over a year. So in SaaS terms, a score of 100% means that your customers are spending the same exact amount as the year previous. And 120% is considered world class. So an NDR of 134% means Palantir's existing customers are buying more products, increasing usage, which of course leads to higher billings, and sticking around. So that's very impressive. It shows that once a client starts using Palantir, they expand heavily over time. So that's what makes this even more powerful is that Palantir isn't just growing by adding new customers, they're also getting existing customers to spend more over time. So growth stacks from both directions here. So, and by the way, they're also printing money with operating margins around 51%, which is absolutely insane for a software company growing at this pace. So if any normal company posted numbers like these, their stock would be going parabolic right now. So right after the earnings report, the stock rose from 205 to 220 in after hours trading, lighting off, I'm sure, euphoria for Palantir investors. But then shortly after, within minutes, it started tanking and dropped all the way down to 183 the following day. So why did this happen after another blowout quarter? Well, this is Palantir, and as always, the conversation shifts back to valuation. So the debate continues. Can Palantir grow into their high multiple? I think valuation concerns are fair. The stock has rallied hard this year, and it trades at a premium compared to most software peers. But what people often miss is that Palantir isn't a normal company. Their revenue growth and free cash flow growth are both accelerating, which means the valuation argument gets weaker and weaker with every quarter like this. And really, this whole valuation debate, we've seen it all before. Looking back historically, Amazon's PE ratio was once considered absurd for years. You may not remember this, but people laughed at it, called it uninvestable, and even said the fundamentals simply don't justify the price. In fact, at one point in September of 2015, Amazon hit a P ratio of 740. Those same exact valuation criticisms we hear about Palantir today were being thrown at Amazon back then. And what happened? Well, AWS happened. More customers adopted it, more enterprises began relying on it, usage scaled, and as the business matured, the revenue expansion brought the PE down naturally. So if we fast forward to today, Amazon's PE is around 35, and the stock is up roughly 10x since that 2015 valuation panic moment. So AWS was transformational. It defined the entire cloud computing industry and became one of the greatest business units in tech history. Now, let's tie that back directly to Palantir. In my opinion, Palantir software is transformational in the same exact way. Industry analysts cannot see it yet, they can't model it, and they can't quantify it, so they fall back to saying the stock is overvalued. They did it with Amazon then, and they're doing it with Palantir now. But look at what the numbers are telling us. A Rule of 40 score of 114. This is unheard of in enterprise software. They are signing $10 million deals at a pace no other software company is matching. And right now, the only companies actually getting real, measurable AI efficiency gains are Palantir customers. Their own case studies show it clearly. Processes that used to take months now take hours using AIP. Entire workflows are being automated with human in the loop precision. So, this is the AWS moment, but for AI. AWS compressed infrastructure time and AIP compresses decision making and execution time. And just like in 2015, the analysts who say it's overvalued today have no framework to the scalability that will occur with this name. All right, now let's talk about what's actually dragging the market down. So I'm sure by now we've all heard that Michael Burry, the big short guy, is shorting again. So this time he's reportedly betting against Palantir and Nvidia, two of the biggest winners of the AI era. So both companies are executing flawlessly with growing revenues and high operating margins, but somehow his short bets are spooking the markets again. I mean, Burry's been directionally wrong for more than a decade, yet his moves still carry psychological weight. Maybe it's because he's had a movie made about him. I don't know. But remember, the S&P 500 is up over 70% since the last time Burry tweeted sell. So I actually appreciate guys like Michael Burry. I think they keep the markets grounded. The fact that him and a few other bears are saying that we're in a bubble makes me think that we're not in a bubble. I mean, bubbles tend to be euphoric. And in this case, the companies that he's accusing of causing this bubble, which are, Google, Nvidia, Amazon, and Palantir, they're producing wonderful numbers on their earnings. So they really have the revenues to back up the excitement. So, by the way, he's also likely down on that trade that was made in Q3 when Palantir was trading sub 170. So, we'll see how that ends up for him. But again, it's not all negative sentiment regarding Palantir. There has, of course, been a lot of positive feedback since their blowout earnings report. Bank of America just raised its price target for Palantir from 215 to 255. And my favorite market analyst, Dan Ives of Wedbush, just doubled down on his bullish take, calling it a core AI infrastructure company, and he stuck to his 230 price target. So he was pretty much telling people to buy the stock on the dip. But going back to price targets, I have to say in one of my first videos when I created this channel earlier this year, I kept a price target of $130 for Palantir, which I really thought we would hang out in that range all year to let it grow into the valuation. I really didn't think we would see $200 until 2027. So this just shows how much and how fast this stock has grown in 2025. So I think if we were to stabilize and stick around the 170 to 180 range, that would be totally fine in my book. I would have blindly taken that like 3, 4 months ago. But now, if you do want to sell Palantir because it's volatile, that's fine. But don't do it when there's a lot of market fear right now. Do it when euphoria returns to the markets. It eventually will. So aside from Burry short, there are still a few real concerns weighing on investors today. After these massive rallies in Palantir, Nvidia, and other AI leaders we've seen in the last few months, some investors are taking profits or rotating out, and that's fine. But there has been growing chatter that the AI trade is overextended, even though the underlying fundamentals keep improving, and it's AI fears weighing the S&P down currently, I think. So I don't know if I agree with that. I think we head into a Santa rally pretty soon, as November and December typically are very good months for the market. And by the way, it's not just me who thinks that. In a recent interview with CNBC, fund strat head Tom Lee says he believes the S&P will reach 7,500 by the end of the year. So that's significantly higher than we are today. So Tom Lee keeps pointing out that there's over 7 trillion on the sidelines and that this money is going to enter the market with rates going down. So you have to imagine some of that money goes into the AI names. So hopefully the end of the government shutdown will be the catalyst for all of this to happen. We'll see. So speaking of politics, there have been some political jitters over the last week. Not only the shutdown, but there was also a recent election in my former home of New York City, which kind of spooked some in the financial industry. I think it could have added to some of the negative sentiment we saw this week. So Zoran Mamdani was elected mayor of New York City. So, previous mayors might have criticized Manhattan's finance sector here and there, but at the end of the day, they kind of understood the role Wall Street played in the city's economy. This time it seems a little different. Mamdani is a self-proclaimed socialist who ran on a anti-capitalist, tax the rich, tax the corporations campaign. And he's been pretty hostile, openly hostile towards Wall Street. So not just being critical, but really positioning himself as the opposing force to the financial sector. So, for the first time in modern New York City history, the largest financial center in the world is being run by someone who has built political identity against the financial industry. So that probably spooked the markets earlier this week. I'm sure it didn't cause a crash on its own, but it definitely added to the overall mood of just caution, uncertainty, and uneasiness. So, by the way, I don't ever want to get political here, but I will say in a city where billions in capital decisions are made every day, it's probably not favorable to have an anti capitalist at the helm. I mean, the mayor doesn't really have a say in corporate taxes, but this move just gives a perception that the city might become business unfriendly again. And this is just my opinion, but other places have tried this before. Specifically on this side of the pond, Europe's financial capital, London, has famously been taxing business owners and the wealthy at higher and higher rates for years now. And the outcome has been that they've been fleeing for other places. So, I wish Mamdani well. I think his intentions are good, and I hope it works out for everyone without spooking the markets too much in the future. All right, enough of that. Onto Nebius. So, obviously, Nebius is a company I have very strong conviction in. They are a neo cloud full stack that I've been consistently covering on this channel. Full disclosure, I currently own 1,500 shares and some very aggressive options contracts, so I am biased. Nebius reports their Q3 earnings the morning of November 11th, so I'm very much looking forward to that. It will be the first report which will comment on their recent $19 billion Microsoft deal. So, with regards to the numbers, I'm looking for a clear revenue beat and a very strong increase in guidance for next year's capacity. I'm also really looking for new and improved ARR numbers. I'm also hoping to hear from the CEO with regards to future deals. I believe a new deal is close to being announced, so I'm looking forward to that. I think they will deliver this quarter and push the price closer to 150. It's been a wild volatile last month with the neo clouds and their price action, but in my opinion, this stock is undervalued. And the general price targets here from some of our friends on Wall Street really do support my theory. And by the way, we did get a new price target this week. DA Davidson met with the team this week, and shortly after they updated their target for the company from $125 to $150. All right, other than the upcoming earnings reports, there was some news this week regarding Nebius you might have missed. So they announced their new UK data center was officially opening. The initial deployment is expected to include 4,000 NVIDIA Blackwell Ultra GPUs, making it one of the first installations of its kind in Europe. So not only does this mean more capacity and more revenue, but this tells us something else. Remember, they announced months ago that the UK data center would go live in Q4. So seeing it actually happen makes me feel very confident that they will keep executing on all of their very ambitious plans. Also, Nebius just launched Token Factory, a new service that makes it easier and cheaper for developers to run open source AI models like Llama GPT and DeepSeek at scale. It focuses specifically on inference workloads and bundles both the models and the compute needed to deploy them. So if we combine this with their NVIDIA exemplar status, the Aether announcement, and now this token factory, it's showing that Nebius is really becoming a top player in innovation in the space. We also learned that Nebius was just added to the MSCI World Index, which is a pretty big milestone. So the MSCI World Index tracks large and mid-cap companies across developed markets. So this is a major benchmark that institutions pay attention to. When a company gets added to this world index, funds, ETFs, and passive investment vehicles that track the index now have to hold the stock. So they don't get to pick and choose, they are required to buy it in order to match the index. So it's kind of a similar story to when a company is added to the S&P 500, but on a smaller scale. So as a result, you get automatic new demand for Nebius shares from these large passive funds. So this increases liquidity, increases ownership from institutional investors, and generally puts more upward pressure on the stock over time. Some other news too, Anthropic is now projecting up to 70 billion in revenue and 17 billion in free cash flow by 2028. So that is up from around 5 billion today as cloud adoption accelerates across enterprises. So why does this matter for Nebius? Well, Anthropic's observability layer runs on ClickHouse, which is owned by Nebius. So as Anthropic scales, that growth flows directly into Nebius's bottom line. Also worth noting that Iren, who is a direct competitor to Nebius, signed their own multi-million-dollar deal with Microsoft this week. Initially, Iren did a victory lap, but then details emerged that their Microsoft deal was not as good as the Nebius deal. IREN will earn 288 per GPU per hour, while Nebius earns 420 per GPU per hour. So Nebius got the better deal there. By the way, IREN did report earnings this week, and they did have a double beat. So congrats to them. All right, last but not least, former Nebius skeptic Jim Cramer, who once famously picked CoreWeave over Nebius, recently backtracked on that, admitted he was wrong, and said there's so much demand for the Neo Cloud that you can be bullish on any of these names. So welcome to the team, Jim. It's good he finally came around to Nebius, but as a respected market analyst, he should have done this sooner. I mean, if you look at CapEx that's going to be spent by big tech, all big tech names in the next 2 years, it's going to be more than what was spent in the last decade combined. So that will be great for the neo clouds and just awesome for the overall NASDAQ. So bullish times ahead. All right, that's it for this week. If you found this interesting, please like and subscribe and let me know how you're feeling in the comments about the recent Palantir earnings. So next video, I will likely dive in and do a full analysis on Nebius's Q3 results. So I'll see you then. Thanks for watching.